Okay, everybody, good evening, and thank you so much for joining us for our webinar on the ins and outs of real estate syndication returns. I'm Margaret Kozlark, one of the co-founders of Noblivest, and I am here with my partner, Christine Shu. So before we get started, just a quick disclaimer that the following content is for informational purposes and is of a general nature. This is not constituting any legal, tax, accounting, or investment advice. Really, for tonight, we're just going to go over some terms and metrics, but obviously, it's always a good idea to consult with your financial professional or do your own independent research. So, let's talk a little bit about our agenda for this evening. We've got a lot that we're going to cover, but we're going to try to get you all out of here in 45 minutes. So we're going to do a quick intro of Noblivest, who we are, talk about why you should invest in real estate syndication, and then we're really going to get into the meat and potatoes, how to determine if a deal is profitable and how specifically to evaluate the potential deal, and then we will take your Q&As. So as we are going through the presentation, if you do have questions, feel free to put them in the chat box and we will address them at the end of the presentation. Okay. So first, a little bit about Noblivest. Christine and I together have been a partner in 32 million in assets under management, just over 1,200 units. These are our 4 assets right now. We've got properties in Dothan, Alabama, the Eagle Rock Fund, which is Houston, Phoenix, and Tucson. We have a short-term rental fund, which is 50 Airbnbs across 8 states. We have Venice Park, which is in Sarasota, Florida, and we are continually underwriting and looking at new opportunities for 2023 as well. So if you are on this call and you are not on our investor list, one thing I do want to say briefly is that we do both 506B deals as well as 506C. So that means that if you are not an accredited investor, you can still invest with us. However, we need to have a pre-existing relationship. So we're going to talk about this at the end, but you need to go ahead and book a call with us so that we can start that relationship and satisfy the SEC. Okay. So let's talk very briefly about what the benefits are of investing in a real estate syndication. So first of all, when a lot of people think about investing in real estate, they think about being a landlord, right? Those horror stories of dealing with tenants, toilets, termites, calls in the middle of the night because someone's locked out. The beauty of syndication is that it's a passive investing. So all you do is you provide your investment and your capital, and then you sit back and you let us do the work. Also, because it tends to be a longer hold, there tends to be a better upside for appreciation. So a typical hold might be 5 years. And during that time, in addition to market appreciation, we can also force appreciation through our rehabs and value add opportunities, as well as improving any operational inefficiencies or looking for additional income streams. So there's a lot of different ways that we can improve the value of the actual asset itself. Multifamily real estate does also tend to be more stable. In fact, in a recession, it is one of the more recession-resistant asset classes. And part of the reason for that is because when we're in a recession, not as many people are buying houses, so they tend to downsize. They go for rentals, or people rent a little bit longer while they sort of try to wait it out and go and wait to purchase their home. One of the other really exciting benefits of real estate syndications is the generational wealth that can be produced as well. So you can basically not only help your family today, but you can pass this wealth down to your children and your children's children. And it's a really wonderful way to be able to set your future generations up with a real advantage. Again, with multifamily, right now, there is such a shortage of housing in the US. There is an extreme high demand, and demand continues to outpace supply. So that is great for people who are investing in multifamily because there's lots of opportunities to find these assets, go ahead and improve them, provide value to the community by providing a nice, clean, and safe place to live, while of course making money for our investors as well. I spoke a little bit about lower risk, but the one thing I do want to mention about that is if you think about being a fix and flipper or even having a duplex and you buy, a 2-family or 3-family, if one of those people don't pay their rent or 2 of them, you still have to pay your mortgage. So that's a real risk as opposed to having a complex of, say, 100 units or more. If one or two tenants don't pay their rent a particular month, that's not going to hurt you the way it would if you had a single family or a multifamily, or a two-family rather. And then most excitingly, there are great tax benefits. So I mentioned that a typical hold for a real estate syndication is about 5 years. So because of that, normally the value of a commercial asset is written off over 35 years. But because it's a 5-year hold, we can front load that depreciation, meaning we can take that entire value and basically put it into 5 years instead of 35. That means that while you are receiving distributions on paper, you're receiving a paper loss. So you are deferring taxes on any gains that you may be making. And for those of you who are listening who are real estate agents, as a real estate professional, you can also use those paper losses to offset your personal income as well, which can really make a huge difference. Okay. So now let's talk about how to tell if an investment is profitable. So first of all, most people, when they think about investing, they think about investing in the stock market or maybe buying a house as a rental or just as their own personal home. And it's really easy to tell the valuation and if something is profitable. If you sell it for more than you bought it, you've pretty much made a profit. Buy low, sell high. Really easy. When it comes to commercial real estate, though, it's a little bit different. Because commercial real estate, the valuation is determined by the income and the cash flow that is produced. And so this is important because it doesn't even necessarily matter if you were, let's say, in a time of inflation or a recession, what the purchase price of the property was, as long as the property is making money. And so this is the equation here that you would look at. You would take the revenue that is coming in, the income from rent, subtract out the operating expenses, and then you would get your net operating income. And that really is what determines the valuation of a commercial property. So if your NOI is higher, the valuation of the property is going to be higher. And then the best thing about commercial real estate is, a lot of people talk about, oh, well, I've got all my money in the stock market and the stocks are doing great. Maybe not now, but let's say they were. But with the stock market, you don't get those gains until you sell the stock. So now you no longer have the asset. You had to sell it to get the gain, and now you're going to be taxed at one of the highest capital gains rate. By contrast, with commercial real estate, you don't have to sell the asset to be receiving that regular cash flow. So it's a great way to get some money coming in regularly. You also still have your initial capital investment over here, and what you're receiving are regular distributions. Okay. So now we're going to go into an exercise to evaluate a real estate syndication. And so what I did was I took some numbers from an actual PPM, and we're going to walk you through it. But before we do that, the way you evaluate a deal is going to depend on what is most important to you. So there really are two main strategies. If your main strategy is cash flow, right? So this would be ongoing income received at regular intervals, sometimes monthly, usually quarterly. And this can be great for people who are looking to leave their W-2 or looking to retire, because it can feel like a salary replacement. So if you are somebody who really wants cash flow, you're going to look at the deal a little bit differently rather than someone who is focused on equity. And equity is basically that large chunk of money you receive when there is a capital event. And a capital event is essentially when we do a refi or we exit the deal and sell the asset. And this tends to be preferred by people who want to continue working, or people who are investing with their retirement funds. So they are not going to have access to any cash flow anyway, so they would rather just wait and get that equity upside. So no strategy is better than another. It's all personal to the individual, but it will affect how you look at the deal.
If I can jump in here real quick before we move forward, I'm just curious, when I get some engagement from everyone, what do you personally prioritize for your investments? I'm just curious.
Yeah, you can feel free to put it in the chat.
Yeah, and this is usually the first thing that we ask all of our investors is what do you like to invest for, whether it's cash flow or equity upside?
Yeah.
Yeah, I would say a lot of people who are like retired or real estate investors where their daily income is dependent on cash flow, they usually try to increase cash flows, whereas if you already have a job, as mentioned here, goes towards the equity upside.
And sometimes we'll have people where, let's say they've just had a baby, right? And so they want to have this investment, and this is going to be the college fund or the fund for their child. So they don't expect this money to be touched for 15, maybe 18 years. So they are absolutely going for that equity to have it keep growing and growing and growing. So as Christine said, it's a strategy, but it's also based on the why. Why are you investing in, and really what are you looking to gain from the investment? So is there something in the chat, Christine, that someone has mentioned?
Yes. Yeah. So it looks like Chris, Denny, prefer equity, upside. That's all we have so far.
Yeah. Okay.
Open to either. Cash flow is nice. Even a modest on quarterly is a certain amount of equity in 5 years is good. Looks like most people are
like equity,
selecting equity. Yes. Yeah.
The one thing I'll say about cash flow, since it didn't get a lot of votes, is when you do your first syndication. So I'm guessing most of the people here have invested in a syndication before, but if you're new, there is a certain comfort to getting that regular cash flow, right? Even if it's not a lot of money, because it's just that monthly or quarterly reminder that your investment is working and that your money is working for you. So sometimes psychologically, cash flow is nice for that. So just throwing that.
Exactly.
Okay. So this is a couple things I want to say about this. This is an actual page from a PPM. Now, I will say, as we are going through this, these returns are amazing. This was from about 2 years ago. So you'll see as we're going through this, obviously the market is a little bit different now, but I wanted to keep it the way it was because all of the calculations worked out. So as we're looking at this, know that this was a legitimate deal and this wasn't numbers that we made up, that we actually just pulled for this example. So when you decide to invest in a syndication, usually what happens is we will roll out a deal. If you are in our investor club, you probably just got something within the past couple of days about a new project that we have. And then we will have a webinar, and then you will get a PPM or an offering summary. And usually you will have this sort of chart of metrics that are in the summary. And sometimes, as I mentioned before, it can be really intimidating because it's like a whole new world and you almost feel like you need a translation guide. So what we're going to do tonight is to just try to walk you through some of these terms just at a really high level to hopefully help you understand a little bit more and have a better chance and idea of evaluating these. And then, of course, if you do have other questions, put them in the chat, and then we can also meet with you privately. So let's talk first of all about the cap rate. Everybody talks about the cap rate. So basically, the cap rate is just the ratio of the net operating income and the current market value of the asset. And the main thing you need to know about the cap rates is that they have an inverse relationship to risk and price. So when the risk is low, the cap rate is compressed, the cap rates are low, and then the price is higher. And then on the flip side, when you have a higher cap rate, then it's going to be higher risk, but the price is lower. So a lot of times the best way to look at this is just what is your comfort level with risk? So, again, most of the things, and right now we're looking at like anywhere from, 4s and 5s in this particular example. Some of the markets cap rates have really gotten compressed, right? So they've come down to like 2s and 3s. So depending on how you look at it, well, on the one hand, less risk, but on the other hand, it's a little hard to make a profit because now you have to spend a higher price to acquire the asset. Okay. So expense ratio. Expense ratio is really interesting. And this isn't always included on every offering summary, but it was in this one, so we wanted to include it. But it's basically what percentage of the gross operating income is needed to cover operating expenses. And this metric is really interesting because it can give you some good insight into how the property is being run. So if the expense ratio is really high, say over 60%, okay, so something's going on there. It's either being run inefficiently or, maybe there's just some kind of ineffective property management, but that presents an opportunity when you are looking to acquire an asset that gives you room that you can bring it down. On the flip side, if the expense ratio is on the low side, maybe 25, 30%, then I would be a little worried that maybe it was being underreported, whether intentionally or not. I would be concerned that that's a little too low. So technically 35 to 45%, I would say, tends to be a pretty good ratio for expense ratio. And by the way, T12 just stands for trailing 12 months. So that's looking at the previous year from wherever this point in time is. Okay, my favorite, debt service coverage ratio. I love DCSR. Basically, I love this because it's basically your padding, right? So it's a measurement of the ability to pay expenses with your current income, or really kind of a buffer. So if you have a DCSR of 1, that means you have just enough money to pay your bills. The higher that number is, over 1, it means you've got a surplus of cash flow and you've got a little bit of a buffer. If it's under 1, then it means that maybe the property isn't profitable or there could be some problems. So that's always something I like to look at, especially now with everything that's going on with interest rates and, prices being so high. It's nice to have that comfort of having a DCSR or DSCR rather, of a little bit more. And some lenders actually have minimums where they may require a DSCR of 1.2 or higher or something like that. So lenders are looking at this as well. Okay, so I'm going to actually pass this over to Christine, and we're going to talk a little bit about, obviously purchase price and some of the other things, and then we'll take any questions that you guys have.
All right, so purchase price is exactly what it is. It's the price at which the property will be acquired. And it's usually acquired with a combination of loans. And this could be either a bridge loan, which is a short-term variable rate loan, or it could be a fixed rate. And that can be from either a bank or from a Freddie or Fannie type of product. And those usually have a longer term and are at a fixed rate. Yep. So there's either that or investor capital. Usually, like when you buy your own home, you have an X amount of down payment that you're putting forth. So that usually, because it is such a large asset, is raised from investors. Mm-hmm. And then next we have our hold time, which is the estimated length of time that the sponsorship team needs to execute the business plan before exiting the deal. And that can either be to refinance or to sell. Most of the time it is to sell the asset, but there are times when you can get a full return of capital at year 5. Basically, your entire initial investment is back to you, but the sponsorship team may decide to hold on to the asset and cash flow. So then your equity in the deal and your percentage of equity in the deal remains usually, and you continue to cash flow on the property even after your money is returned. But typically, I would say more times than not, it's sold, and that's the typical hold time.
And the other thing I do want to mention, Christine, is that although a hold time may be targeted for 5 years, there may be situations where they either overperform or outperform the business plan, or they get an amazing offer to sell it early and they decide to exit early. So it's not set in stone.
We've seen a lot of that happen in the last few years.
We absolutely have.
With the boom of real estate.
Yeah, exactly.
All right, next is equity required. So usually you'll see this in the investment summary. It's how much capital needs to be raised from investor. I would say in the last few years is around 30 to 35% because LTV values were higher required from the lenders. But recently you'll see a lot of the LTVs in the 50 to 70% range. So that would require more capital to be raised from investors. And then also in terms of raising capital, it's not just for acquisitions. These funds are also could be allocated to things such as cash reserves or CapEx expenses. So if it is a heavy lift renovation project, most of that capital would be raised from investors. And then next is the equity multiple. And this is the ratio used to understand total cash return over the life of the investment. So it does account for the whole time. So basically, for example, if you invest 50,000, and the equity multiple is a 2x, then you would expect that you would receive 100,000. And this includes both your cash flows as well as the equity upside. So it is in total at the end of the investment when it goes full cycle. And then next we have another example of this. So with the equity multiple, you see the ratio is the total returns, net profit as mentioned. Cash flows plus upside divided by the total equity invested. And here is just an example of, the different cash flows that you see year over year, as well as the return of capital here in year 5, plus whatever gains are from the sale. And so here is showing a 2.13 equity multiple example. And next is the preferred return. So a lot of people do kind of mistaken preferred return as synonymous to cash flow or cash on cash, but it is not the case. So preferred return actually is whatever initial return is going to the LP investor as the preferred position. So it is the return going to investors before any general partners or sponsors receive any share of the profits. So typically we see that now between a 6 to 9%. A lot of times for projects that are more cash flow heavy, you could see them between 9 to 12%. And also, if you see that a property needs to be stabilized, investors may not necessarily receive the full pref in the first year. And sometimes even you may not even receive the full pref throughout the investment whole time. But all of that does get accrued and is paid once there is a capital event, whether that is a refinance or a sale. So if there is not enough cash flows to kind of meet the preferred return, then whatever upside is gained from the capital event is then accrued and paid out to the investors. Next is cash on cash. So this is the rate of return that calculates the cash income earned on the property. And this is based on the total amount. So there is no time value to this one. It is calculated by taking the total returns over the period of time divided by the investment. So the total period of time that is. And here you can see the example showing an 8.8% cash on cash, which is different from your 7% return. And then next is the average annual return. So this is the return of the project over the term of the project, so overall term. And it typically includes returns from both cash flows as well as the proceeds from the sale in the calculation. So typically you wouldn't see your average annual return until at the end, and it's calculated based on when the property goes full cycle. And next is the internal rate of return. So all of the other ones are kind of just general metrics. This one accounts for the time value of money. So this one sometimes can be a little bit challenging to understand. There's a very complex formula for it, but basically it's taking account for your time value of money and what is generally believed what a dollar is worth in the future, accounting for that along with your returns. So typically we see opportunities between something like a 14 to an 18% internal rate of return today. Sometimes we can see higher than that. Sometimes we can see lower than that. And what is always nice is if we kind of do a sensitivity analyzer, you can kind of see what those differences are based on the different levers and thresholds of the deal. So it could be something like, rent projections or cap rates. So sometimes we'll have those grids to kind of see, well, in this case scenario, this is your return, or in that scenario, this is what your return could be.
And just to interject, a great example that I heard about this when you're talking about the time value of money is if somebody said to you, you can invest, $50,000 today and we'll double your money, you'd be like, great, that's terrific. And then they'll tell you, well, it's going to take 20 years to double your money. All of a sudden that deal doesn't look so good versus if your money could be doubled in say 2 or 3 years. So that's really kind of where that time value of money comes into play.
All right, other factors to consider are the debt structure. As I mentioned before, whether the debt is a fixed or variable rate. Usually for variable rates, those are with value add type opportunities, because when you're in a fixed rate, you're locked in for either 5 to 10 years or beyond. Variable rates usually are shorter term. So if it is a value add project, you can kind of have that time frame to do your renovations and then refinance it or sell it, but you can refinance it into a longer term product from then at a higher value. So usually if it is bridge debt, right now, especially because of the quick increase in rates that we're seeing this year, it must have a rate cap. So rate caps are usually purchased to make sure and ensure that the rate will not go beyond a certain point. And there is a cost to it, and usually those costs are factored into the underwriting of the project. Also, another thing to consider is the demographics, median income and population trends. So as we mentioned in our previous webinar, that is something that we definitely look at is in the market, what the incomes are, what the populations are, making sure that it is a growing area and that the rents can be supported by the incomes. And also job outlook. So another important thing is that there is job diversity. What is the unemployment rate in the area? So these are also important things along with the demographics as well as geography. So the location is really important. Is the property in a landlord-friendly state? Some are more friendly than others. That is just to ensure, keeping a good relationship with the tenants. And then also potential weather concerns. So that could bring additional costs to it. It's not to say that these are bad places to invest. They're not. They're great places, but they are just other factors that we have to consider to make sure that we have enough reserve, whether it's for insurance costs or for any miscellaneous events that could happen, such as hurricanes or freezes that have happened a lot in Texas, or tornadoes, whatever it could be, floods. These are all accounted for in the planning and the underwriting.
And just as an example of that, after the major hurricane last year in Florida, a lot of insurance rates went up in Florida. So that's something that you would absolutely have to factor in to make sure that your cost analysis still supported the acquisition of the property. So that is pretty much the main content that we wanted to go over. I know we threw a whole bunch of terms at you. So we're going to open it for Q&A. If anybody has any questions or any comments, you can go ahead and put them in the chat. I will say, Christine, people have asked me in the past what we look for in terms of metrics. I don't know if you want to speak to that, like what Noblivest looks for.
Yeah, absolutely. So the metrics that we like to see, of course, it has changed with the current market landscape and the debt environment. But we like an IRR of at least, now it's 14%, used to be 15%. But at a minimum 14%, we strive for 15 or above. We like to have some cash flow. So a lot of our investors want a combination of cash flow and equity upside. So that's why we're looking at value add class B opportunities, because usually those are the ones that do offer a little bit of both. It is steady cash flow plus a really good upside due to value add business plans. And then I know an important one that you look at is the DSCR in our deals. I think in the last few years with the LTVs and debt being a little bit higher, we've seen DSCRs kind of fall into a 0.8 in terms of an entrance.
Which is kind of scary.
It's a little risky. It really is. But really, a lot of the sponsors do justify that because it is a value add component. They're really driving the NOI up as quickly as possible. So if they feel confident they can drive the NOI up within the first 1 to 2 years, they can actually exceed, that 1 or 1.2x DSCR. And then also going back to the cash flows, we're looking at typically of 6 to 8% cash on cash currently, especially for our value adds. We also are we do have a subset of investors who really like to invest for cash flow and purely cash flow. So we want to be able to offer those opportunities where we can offer that 9 to 12%. But usually there isn't any equity upside there. It's just steady cash flow. And then I would say also preferred returns. We like it between 7 to 8%. So we really want to advantage the LP investor and make sure that, those 7 to 8%, the first 7 to 8% of returns goes to our investors. Is there anything else you wanted to add?
I did want to mention when you were talking about the DSCR and how some operators justify having it a little bit lower, it reminded me that another factor that you really want to look at is the track record of the operator, because an experienced operator can absolutely work with those numbers and can take a deal that may not seem that great and just make it just an amazing rock star. And on the flip side, a team that's a little younger and maybe not as experienced, especially now with the market shifting, can take a deal that looks amazing and can just completely botch it. So it's really important as you are looking to invest in deals that you want to ask some questions about the experience of the actual operating team and the sponsorship team.
Yep. We do have a question in the chat. Can you go over the assumptions you make on inflation on things like labor, material costs, and taxes?
So for that, a lot of what we do, because we have the benefit of having, I always say real estate is a group sport, right? It's never done alone. So a lot of times with that, we will confer with the operators and the folks who have the boots on the ground. Since Christine and I are based up here in the Northeast, and a lot of times the properties that we are investing in alongside our investors are in the Sunbelt states, then we will actually certainly look to our partners to advise the people who have the boots on the ground what makes sense in terms of something being a market rate. And a lot of times we will work with people. So we've got a project. I don't think I'm allowed to say too much about it because it's a 506B, but I'll just say this. It's in a market where our partner has about, is it 25, 30 other properties? 40 in this particular market. So not only do they totally have their finger on the pulse of the pricing of things like labor, material, and taxes and costs, because they are such a big operator, they also have really good bulk pricing that they get, because literally their suppliers, they have the same kitchen reno, the same stove, same appliances for every unit. And so that obviously that bulk pricing really keeps the prices down. Any other questions you guys may have? I'm trying to think of anything else people have asked me. I will say one thing, everybody's a different kind of learner, right? I remember I took this class one time and it talked how there's visual learners, there's auditory learners, and there's kinesthetic learners, which are like hands-on people. So definitely, if you are interested in an opportunity, whether it's one of ours or someone else's, figure out the communication mode that works best for you. Some people may want to look through every single page of the deck. Others may want to prefer something like this, where they're on a webinar and they're, have an opportunity to talk to the sponsorship team, ask questions, and then still others may just prefer to try to do like a one-on-one call. So whatever method is comfortable to you, definitely make sure that you are doing your due diligence and making sure that any questions you have are getting answered in a timely manner.
Yeah, I want to add one question that I receive a lot, and also when I was a newer LP, when I first made my first investment, and I do kind of hear this a lot, why is the first distribution so low? A lot of times it is very low, whether you get your first distribution after the first quarter or after the first 6 months or the first year. Sometimes a lot of that depends on whether the property is stabilized. And usually, because we invest in value add, usually it's not stabilized. It takes usually about 2 to 3 years to fully stabilize a property. Because if you think about it, for tenants that are in existing leases, they have to kind of carry out their full lease. So we're not raising rents on them, on existing tenants. We're not doing renovations. We're not kicking anyone out. If they're already on a lease, it takes time for their lease to come due before there's any changes to the property. So because this is real estate, things are a little bit slower. A lot of times in the stock market, you just push a button, go. Tomorrow you'll see something go up, and the next day you'll see something go down. It's very fast. But in real estate, it's a slow and steady type of movement. So you've got leases that are due. There's a lot of other factors. There's the renovation timings, the schedule of construction. All of these things kind of take time. So your first few distributions usually will be on the lower side. It's not until typically around year 2 or year 3 where you start to reach your profit. And it depends. I'm not saying that as an absolute. It depends on the deal, and it depends on the timing. So if you're looking at an opportunity, these are good questions to ask. Really, what is the construction schedule? When do we envision to stabilize the property? And what's the plan? So definitely pay attention to that. And don't be worried if you see you're only getting, like couple $100, something really low in the first few distributions. That is normal. So just want to kind of put that out there as well.
Yeah, and that's a really good point, because I think we tend to, Christine and I, end up looking at value add because those are the properties and the projects that we like to do. So that's absolutely how something like that would run. There are others who may buy for a buy and hold, right? So they may look for something that's more of a Class A property, that it really doesn't need a lot of improvements, and it's a pure cash flow vehicle. And so in those cases, you may get your cash flow going pretty steady, but you're not likely to get a lot of equity upside at the end, because you're not necessarily, forcing that appreciation by improving the asset. Maybe you can, find some additional income streams like, carports or valet trash or something like that. But for the most part, that's going to be a cash flow play. So it really depends on the deal, what you're looking for. So.
All right. Do we have any more questions?
Yeah, last chance. And while Christine's checking the slide, I do want to put up this. If you do want to get in touch with us, as I mentioned, I think most of us on this call know the difference between 506Bs and 506Cs, but just in case you don't, 506C deals mean that anyone can, any accredited investor can invest in that particular project, and you don't need to have a pre-existing relationship. So I could meet somebody at a meetup tomorrow, they could like my deal and decide to go in for it. And those are the deals that can be advertised. So a lot of times if you see those deals, those are usually 506C deals, always actually 506C deals. 506B deals, by contrast, these are ones that require a pre-existing relationship. So whether you are accredited or not, it doesn't matter. It is open to people who are not accredited. But even if you are an accredited investor, you still need to have a pre-existing relationship. So what does that mean? Does it mean we have to go on a date? No, but it does mean you should schedule a call with us. Give us an opportunity to discuss your goals, understand what you're looking for. I always start almost every call by saying, this is not a sales call, right? I'm not here to sell you anything. I'm here to understand what you're looking for. Some people, especially if they are very high earners and they've been used to investing in the stock market, this is a whole new world for them. And so we want to give them that space to take time to understand and learn. As I mentioned, there's a whole new vocabulary, a whole new way of sort of looking at investments. And sometimes that takes time. Sometimes it could be a year, sometimes more. So our job really is to be, kind of somebody to help with education and almost provide you, to help you get some knowledge. But it's not anything where, oh, geez, I have to book a call. They're going to try to sell me something. It's not like that at all. So if you are on this call and you haven't had a one-on-one conversation with either Christine or myself, I do encourage you to please do that. And then once you do, then you will have access to our deal list, and you will get notified of any future projects that we have. So I think that looks, I don't see anything else in the chat. And do you see anything on your end, Christine?
Nope, looks like that's it.
All right. Well, then we want to thank everybody for joining us. Again, I know we threw a lot of knowledge at you tonight, but everybody here and anybody who's listening that couldn't attend live, of course, you're going to get this recording. And as you are watching it or evaluating your deals, our job is not necessarily to help you determine what's right for you, but we can certainly help you decipher and explain what various terms and metrics means. So if you do have any questions, feel free to reach out to either one of us. All right, thank you so much. I think we're going to go ahead and end then. Have a good night and happy investing, and hope to, oh, hold on, there's one more thing in the chat. Let's see. Oh, thank you, Denny. Appreciate that. You guys have a great night, and we'll talk to everybody soon. Take care.
Thanks for joining.
Okay, bye.